Hello, welcome back. Today's introduction video is entitled Understanding Loans and Interest. Okay, so what is a loan? A loan is a borrowing of money. One party requires money for some purpose. Let's say it could be to tide over a short-term cash flow shortage, or they might want to set up a business and acquire a stock or plant or premises to enable them to do that, or they might want to buy a house, or they might want to put up a guarantee because they are importers of a product and they need to put up some cover for that so that the exporter who is sending them the product knows that they'll get paid. That's a loan. It could be for any reason, and it could be for just about any term period. So when you apply for a loan, the bank will assess your ability to repay that loan. That's called a credit analysis or a credit risk assessment. And if you pass that assessment, by you, I mean you could be an individual or a company or a government agency or any type of borrowing customer. If you pass that credit assessment, they will lend you the money, assuming that they are happy to lend the amount you've requested and for the time period that suits your purpose, your need. Okay, and then you will agree a repayment schedule for the loan, either a fixed amount every month, or it could be simply the interest on the loan, and then you repay the whole loan amount at the maturity of it, or you could pay a bit of the loan each month along with the interest. What is interest? Just that, the interest rate that the bank charges on the money it has lent to you. An annualized rate. It could be 1, 2, 3, 5, 10, 15, 20%. And that rate is an annualized rate, but it's calculated on a daily basis, accrued interest, and that interest amount is added to what you need to repay alongside the original borrowing amount. Okay, so that's the interest rate payable on the loan. Interest rates are a function of a number of things, the interest rates in the marketplace, as well as your own credit risk assessment for the bank. The lower the credit quality of a borrower, the higher the interest rate he or she or it has to pay. The higher the credit quality, the lower the interest rate they pay. Why? Because higher credit quality means lower credit risk, which means the bank can charge a lower rate of interest to the loan it makes, because the rate of interest is the reward, the return that the bank receives for making the loan. Money has value and also has time value. Money doesn't have zero value. Otherwise, there would be no incentivized to either lend money to someone or to deposit money with a bank if there was no value. And the value of the money is measured by the interest rate it attracts, either as a payment if you are a borrower or a receivable if you are a depositor. The term of the loan will also influence potentially what interest rate is charged. A short-term loan, may attract a slightly lower rate than a long-term loan. But really, it's the nature of the borrower's risk that drives the rate payable on loan. Credit cards, and you may well be familiar with this already, credit cards come with a relatively high rate of interest because they represent a higher risk of lending for a bank than, say, a mortgage loan or a car loan. If I borrow money from a bank to buy a car, and the loan has to be repaid in 3 years, if I default on the loan, by default I mean I'm unable to carry on paying the interest on it, or I can't pay the loan back, the bank can always acquire the car back from me and use that as a way to recover their loan amount, similar with a mortgage. On the other hand, a credit card is unsecured borrowing by the credit card holder. If I'm unable to repay the loan on my credit card, the bank has no collateral, no security to take from me to try and recover its loan back. That's why credit cards have a much higher rate of interest on them than, say, a personal finance loan or a car loan. The other thing about credit cards is there's no fixed repayment date, is there? You could keep the balance on your card going for a long time, just paying the minimum monthly amount every month, and the bank would never know when it's going to get all its money back. In fact, there's two types of credit card customer. Ones who pay the whole amount back every month, and ones who carry on running the loan on it. And because credit cards represent a higher form of lending to other types of loan, there is a higher rate charged on them. Okay, that's loans or lending and interest rates payable on them. Thanks for watching. I'll see you soon.